Good morning, everybody. Let me finish setting this up and we're good to go. Got a little bit of weather this morning. All right. So what we're looking at here is a little bit of a summary on what had caused that really violent move that sent us to the downside 10.5% in the S&P. And it's a collection of things, right? It wasn't just one thing. There was multiple things. And if you read through all this, one of the things on the list was the jobs numbers. And we're not done with that, right? We got more job numbers coming. So sure, there was, the Japan carry unwind, CTAs and VC funds. So political uncertainty, the whole, crowded trade in AI, it's a whole list, right? They pretty much threw everything at it on what they could blame. But on top of all of it, we still have to remember is that there was some jobs numbers in there. And we're going to be getting more job numbers, and the market could react to those numbers. So far, we're basically flat. We were a little negative, kind of bringing it back up to zero. Looks like markets around the world are waiting on this. Europe's a little more heavily negative, but everything else, US, Japan, Hong Kong, are basically flat, just waiting it out. We're looking at initial jobless claims. And then, of course, we're going to get inventories, and we've got a Fed speaker this afternoon barking. That sounds about right. Usually they're chipping teeth. This time they're barking. We got auctions today as well. Yesterday's auction was perfect. It was a really bad auction, but the effect, the move was perfect. If you were prepared for the 1 o'clock auction, not knowing if we were going to go up or down or not, that was the final trip, right? The leg kick, the sweep. It just took the market's legs out from underneath it. So we got more auctions today. Some will argue that the 30-year is a bigger deal than the 10. I would say that's like trying to argue which one of your dogs you like better, or maybe which one of your children you like better. Probably shouldn't do that. The 30-year or the 10-year, I would watch both of those, and I would give them equal respect because they can move the market. So you definitely want to know what time is the auction and don't let it sneak up on you. Watch the clock. It's one of the greatest tools that you have as a day trader is knowing what time it is. Once we're through with the 1 o'clock auction, I don't think there's anything left in the afternoon for us other than barking. It's a webinar. Speaks during an NABE webinar moderated by Morgan Stanley's Ellen. Yeah. They're probably going to pitch him some softballs and let him sing out of the hymn book. I wouldn't expect much, but just always keep in mind if it's live that he can say something on accident that he didn't mean to say. He can say something that is taken out of context in a way that is misrepresentative of what he was saying. And the algos can, take what he says the wrong way and trade into him. So whenever there's a Fed speaker talking, especially if it's live, not those pre-recorded message ones, and if there's going to be Q&A, you need to be mindful that he's out there chipping his teeth, because they can move markets even if they didn't intend to, right? It happens. It's happened before. Oh boy, it's happened before, and it will certainly happen again. I usually go to finance juice when I'm wanting to keep track of a particular situation like that. Say Barkin is going to be talking at 3. Bring up finance juice, and if he's saying anything that they think will move the market, they'll highlight it in red. Otherwise, they will post the things that he's saying. That way you can see if what he's saying is moving the market. We're at the put wall. We got underneath it last night, but we managed to hold it for the time being. Futures are traded 24 hours a day, and the algos don't stop. But a lot of the firms won't trade it overnight. They don't need to, right? They'll be back in the morning. So the fact that we're underneath it and that we're now back here, it was support yesterday into the close, and it did what we would expect it to do. We saw the monetization of puts. But once that happens and we start chopping like this, until we get away from it, we leave it significantly and then come back to it, we can no longer look at it as a support or resistance level. And it gave us a low down here to kind of give us an idea of how far it needs to go up or down for us to consider that it's left the zone. So for the downside, it's going to have to go lower than this low before it could come back to it and be seen as hitting some form of resistance. And to the upside, it would need to go higher than this and then come back to it for us to see it as having found some sort of support. Otherwise, if we just continue to chop in here, then we can't look at the line as we're crossing over it back and forth as any sort of support or resistance. And if you want to tighten that up, then you could use this second structure here and do the same thing. Set it on both sides. There's your plus and minus. As long as we're in this zone, 5250 to 5200, nice, beautiful round numbers, right? I kind of like that zone a little bit better. We stay in that 50-point range, then that put wall is just gravity. We're just going to continue to hang out there like a cog line, and we're on a cog line, so that makes sense. We're just going to hang out there, and we won't consider that put wall support or resistance. If we get outside of the box in either side and then come back to the line, then it will be a support or resistance. We got the founder's note for the AM edition right before I started the stream, so I didn't get a chance to check it out too much yet at this point. But in last night's, one of the things that they continued to highlight is that we're picking up a lot of option levels lower down. And they made it clear it's not that they think we're going to go lower down, but the fact that we're building structural options levels lower down implies that the market thinks we could. That's something to be mindful of. We have a very wide central pivot channel today. And it's within the central pivot channel of yesterday, although it is lower. A wide channel generally implies that breakouts would fail, but in a high volatility environment, price is going to do whatever it wants, and these channels don't move price, right? They just give us an idea of what price should look like today. We've seen quite a number of these wide channels that turned into a big trend day anyways. And it's high volatility markets. So take these with a grain of salt, especially in these conditions. But it is a wide channel, slightly lower than the previous, and we're underneath it. If we open underneath that pivot, then it'll be a level that we'll focus on that we have to get through on the way back up. It's worth noting yesterday when we were falling where we paused in the fall. It was on the pivot point. Got a little bit of a pause there, and then we got the auction and down we went. Okay. That was a really nice sell zone yesterday. It worked exactly like it should. It's nice when the markets are behaving. So we got the ADR. We're a little closer to the upper ADR than we are the lower ADR, but we haven't hit either one. In a hurry up and wait scenario, we could sit here all day without hitting either one and just go sideways through the day. I think the market's waiting on the jobs data. So, we're sitting here biding our time until we get the data we're looking for, and then we're likely to see a move. That's kind of what I'm thinking. I call these situations hurry up and wait. And, it's not uncommon for the market to just go sideways while we're waiting on data. And the data can be something like NVIDIA's earnings, right? It doesn't have to be necessarily a big economic event. And I use that one as an example because last earnings for NVIDIA, we had 2 days of sideways, almost 2.5 days of a really tight sideways boring market because of NVIDIA's earnings. So it's kind of a big one, but it doesn't have to be economic events. And that's kind of the point. So another thing about that sell-off yesterday, or the level of restricted access higher, and it matched this pivot that I talked about earlier in the week. This is a high volume node, HVN. Often call these price shelves, but really, you give it any name you want. There wasn't a lot of trading that contributed to that, right? Just this little pocket on Friday. But we built out a lot of volume there. And sure, it's not last week's point of control, but it was a heavy volume area. And call it unfinished business or trader's remorse, either way you want to look at it. There was a lot of trading done there, and we left the range and we came back to it. Think about it from your own point of view. If you entered here, long or short, and 3 days later, we're right back where you started, what are you going to do? Probably going to do something with your position. So we would expect trading at that level, right? That's what we got, trading at that level, and it held. The sellers were right there, and every time we got into that 53.50, they were happy to sell it. We don't know if they're done yet, by the way, right? That's to be determined. So here's where we're having a problem. This midpoint 52.32 cog line. It's the halfback. And after this sell-off, every run back up has been sold into 5,300, 5,350. Look at these big wicks here on the last 2 days. Every attempt to get back outside of this very large candle has failed so far. Here we are giving it another try. But while we're trying to give it that new try, we are continuing to get lower lows. If we were to use an OCR analysis, which is a bit of a more modern approach, it's using a single candle. OCR is one candle reversal, OCR. If we were to use OCR, we can see that we're getting these lower lows, right? Even with that outside bar of yesterday, where we had a higher high and a lower low, we're still getting these lower lows. And we're still trapped inside of this really big bar. So this is still the dominant bar. It's still the candle of concern. We still need to get outside of this range, and yet we continue to not do that. We're looking to see if we're going to find some good buyers down here, the same buyers that brought us back up off of that 5120. At what point will we start to see them show up? And are they going to be persistent enough to keep this up and get through this wall of sellers up here? That's the rub, right? That's the problem. We're not done yet. We still have the cumulative volume index, by the way, with net selling on the week. So now that we've got yesterday's range, I want to plot that out. The halfback 5270, it's going to be the level we got to get through if we can make it through this ADR half. The profile is showing that the point of control is at the high, and it wasn't because we spent all night building volume up there, right? All of that volume was from the first half of the day. And it shows that we built a lot of volume up down here at this 5250 area. We can see the high volume node and another one here. We didn't spend very much time down there at all. So this is the high volume node that we have to focus on getting through, which is really our own Globex high at the moment. But even if we get through that, 5250 is going to be significant, and it's got its own trouble. And while it's not a point of control, it is the second largest high volume area on yesterday. And this isn't a very clean example, but that's a classic P shape with the profile in the upper part and the point of control up there. But if we'd have spent just a little bit more time, it would have turned into more of a D shape twice. It's a B, right? But we don't say it's a B. We say it's a D here and a D here. It's a 2D or a double D with the point of control in the upper D. The double D is important because it takes away any sort of bullish bias, whereas a capital P is bullish. Capital P with the point of control in the upper area, that's considered bullish. Doesn't seem very bullish at this point. And one of the reasons the textbooks kind of screw up on this is they consider a capital P bullish because they think of price running into it and then chopping at that level. And then of course you get the volume up there for the day. And when you look at the profile, it has this P shape. Well, that's not the same as a market that traveled up there and then sold off and had a P shape profile. Textbooks don't lay it out that way. They just lay it as the capital P profile is considered bullish, but that is now a significant resistance over our head that has to be dealt with as well. 53.50, 52.50, and 52.32. There are some structural options levels down here. They're not the put wall, but we have 51, 5200, 5150. There's a cog line at 5192, 5132, 5111, and the round number. So we've got some structure down here, but we're still in negative gamma. And if we break, I'd say 5200, but really if we break yesterday's low, I think it's game on to the downside. We would have the opportunity to really expand. I don't think it's going to be as fast as it was last week and as violent. But the thing is, it could be, right? Because, well, because if we break that level, it's going to get a little wild. Yesterday's low, if we break that, gives us a chance to get down to Monday's low. It'd be the low of the week. If we overshoot that and get below 5,100, I think it puts 5,000 on the table fast. And as much as it may feel bullish this week of what we've gotten done so far, we haven't done anything. This is where we closed on Friday, the top of this box. And this is the low that we set Monday at the bottom of this box. So from Sunday to Monday's low, Sunday night to Monday's low, this has been our range for the whole week. The longer we stay range bound like this, the more energy we are building up. And sure, it's a really wide range, but it's still a range. $10-day, 30-minute volume profile. It's doing exactly what we expected it to do. We're building out volume at this level. The question at this point is which one of these two are going to be the new point of control? We're hanging out down here at the moment, so it would kind of imply that this is going to be the new structural level, but we're going to get the jobs data and we could pop up into this 5350 area and build out more at that zone, which would be right inside of last week's close. And it would imply that that's where the point of control is going to go when it moves. We've got a lot of volume to unwind here, days worth of volume still to unwind. So it's not going to happen today. May not even happen this week. We want to see when we run up into these highs and we test this level, how much more volume we're getting up there. Remember, that's where the point of control was from yesterday. So we built out a lot at that level, showing a lot of sellers are there. If we come back up, we want to see, are we still seeing a lot of sellers there? A lot of volume hitting up at that level. We're certainly not seeing a lot of buyers picking up with strength along the lows, right? When we closed yesterday, for an example, we stopped going lower because, well, we closed. Wasn't necessarily because we got saved or a lot of buyers came in and picked it up. We did hit that VPOC from Monday. So the greatest amount of volume traded on Monday was hit late into the close yesterday, and it's been hit in the overnight. We're done with that level, but we're going to take it with us and bring it over here because we got a new VPOC from yesterday. That'll do it. So we just got a new one, 53.37. And they're just stacking up, right? Any move to the upside, we're going to have to work our way through those VPOC levels. This is a really tight profile this morning, like a D shape. Implies that we're waiting as if we didn't already know from the very tight range that we're in, but we are in a hurry up and wait mode. The market's waiting on data. We're assuming it's just the jobs data, but there is more on the table than just the jobs data today. So we want to keep an eye to make sure they don't come out with a market maker move after the jobs numbers. We don't have one yet. So another thing that we could be looking for is a market maker move before we get the jobs numbers. Ignore the volume for the moment. You can see there's a cyan line inside of this volume. It's the open interest on the futures. The open interest shows us the amount of trades that are still open. Make that line a little bit bigger. Now, it's not unusual for, the funds and the firms to start exiting out of the positions before we get to a contract change. The next contract doesn't end until September, so there's plenty of time. This lines up perfectly with the start of this sell-off. And so far, other than a little bit of move to the upside here, which, by the way, gave us a lower high and another lower high, we broke this low. We're printing a new low. Now the day's not done, so this thing could point back in the other direction before it finally closes, and then it would end up being a higher low by the time it's done, because this node right here, it's yesterday's, is the one that we got to focus on. Make it easier to see that node. The current dot don't matter, right? That's the takeaway. This dot could end the day higher, which would make this dot higher than that, and then we don't have our lower low yet. So today still needs to close. But if it closes down like it is pointed to right now, that's going to be a new low. And then we'll have two lower highs, two lower lows in the open interest, and it's continuing to drop. The market has been sideways all week. Open interest is not. It's continuing to break down. And if you wanted to plot that open interest, by the way, you don't need to use it through the volume. You can just use Thinkorswim, type in open interest. It's right there. And so you can steal the one from volume and move it, or you can load a new one as you want. That way you can look at it without the volume. Either way. Yeah, futures and options are a lot closer together than people think. When they were creating the options markets way back in the day, they used futures as guidance, right? Like a template to figure out how they were going to do an options market. So things like open interest come from that world. We're still 2% below the 10-day. It was more extreme than that. So while it sounds bad, 2% under the 10-day, we are on the rise back towards zero. Even though we haven't really gone anywhere, right? We've been sideways all week, staying inside of Monday's candle. We're getting closer to the 10 because the 10 is coming to us. All we have to do is sit tight and the 10 will come down and then we can jump it and run over it. There really isn't a lot of decline lower than the low that we had already set without first getting a little bit of a retest, right? If you look back through history, when we'd have set deep lows, we get a reset first before we set deep lows again. Now that's not guaranteed, but that's generally how it goes. Even when there's been quick, violent moves back in the other direction, we still came back up and then dropped back down, and right, it's a bit of a wave. 2% below the 10-day does imply that there's still room to the upside, which wouldn't be considered bullish. I know I get it. Been having a lot of people say, can we go long? Can we go long? I mean, you could, right? It's your money. You want to try it. But if you look around, a lot of things rallied into resistance and then stalled there. So sure, there was a rally. That's the first part of the sentence. But the second half is it stalled there. And a lot of things, once they stalled, they either have been holding that level or they have faded back off again. That doesn't say short the market, but it also doesn't say go long. It says we're at resistance and we haven't made it through there yet. Which frustrates people because they think we're either in a bearish environment or we're in a bullish environment. But how about we're not doing anything environment? We're just hanging out here waiting. The entire market is trying to figure out what it wants to do for the last part of this year. Are we going to end 2024 in violence and negative markets, or sideways markets, or positive markets? They haven't decided that yet. On the 10-week, 3.5% is a stopping point that we don't normally stop at, right? So where we're at now, this is not typically where we stop. We're either going to go deeper than this, or we're going to, well, really, I don't see any other way except we're going to go deeper than this, right? There was a reversal back here in February, but I believe that lined up with some data and stalled us from a deeper sell-off. So unless we get some data that flips us over, I see that we're going to get farther away from that 10-week to the downside. Because if we were going to pause and stop and turn around, it would have been around 2.5 or so, and we didn't do that. So sure, we could get some data that turns us around and brings us back the other way. Otherwise, it looks like we can get below 4% before we start to find some structure, right? It's 4.5% away from the 10-week. I think that might be what, like a 400 period moving average on a daily or something like that. That sounds a bit extreme. It's not as extreme as it sounds. 49.50. It's the April low. Well, that's not out of line at all. So if we continue to get negative, well, there's your YOLO. Still not seeing that flight to safety in the sectors. I looked up the pair yesterday, looking at the ratio chart, and you can clearly see a flight for safety when you look at the ratio. But if you look at the sectors themselves, you'd never know it, right? But when it comes to the ratios, staples are falling less than um, discretionary. And that's what the ratio looks at in a flight for safety. So this has fallen 7%, and this hasn't even fallen a half of a percent. And what that ratio is looking at is one versus the other, right? Which market is holding up, which one isn't. So it's not necessarily which one's positive or negative, just which one's doing better than the other. On Thinkorswim, there is a an indicator that you can use called price ratio, and you can just put in whatever pair you want. You can use pair ratio or price ratio. Come on, Thinkorswim. When this is going up, consumer discretionary is doing better, like your Mag 7s. When it's going down, staples is doing better. And that's what they call a flight to safety. So we're not necessarily seeing it when we look at the ratio, but we can see it when we look at the ratio, but we can't see it when we look at the sectors. There's the anchored at VWAP. Really hasn't moved that much. Still sitting where it was because it's a yearly anchored VWAP. It doesn't move much, right? When it does, it tends to stand out. Brian Shannon talked about that in his book, how if we do get a lot of violence, that the VWAP will shift very suddenly and it'll leave like a straight line behind, right? It'll say pop up and it'll be up here, or it'll drop down and it'll be down there, something like that. So you can see it shift, but it hasn't. Still in the same spot. The one on Thinkorswim, I haven't been looking at the ES with it since it was detached and floating. I've just been going over to TradingView. See how these aren't connected. And it's because of the contract change. So when it's doing that, I just go over to TradingView and look at it over there. Yeah, I'd rather lean into spot gamma than some Joe Schmo on Bloomberg. The other day on Bloomberg, they were asking some fund manager what he should trade and what people should be looking at, and he told them, "Oh yeah, you should totally go buy gold." Right when there was a global margin call and gold was getting shorted by the big banks like crazy. And what was his recommendation to his investors? Oh yeah, you should totally go buy gold. So, when it comes to levels of structure, I think I would lean into Spot Gamma's founders note. And they did a really good job of drawing a line in the sand. And they've made it very clear if we break X level, then we're flash crashy down to 5,000 and then some. The PM edition is the one that you want to read, I think, if you want some of those levels. From an information. Yeah, I mean, owning some physical gold, you can't go wrong there. It irked me to no end that, the guy was like, oh, well, yeah, we just tell all our investors they should totally go buy gold. And it was right after that global margin call flash move here the first day, and he was telling him to buy it this day. Now, could it rally and continue to go up? Yes, but just like the Kramer, bash on Kramer, he's generally wrong in the front. Within a few days of his initial statement, he's generally wrong, but he has a longer term perspective, which is why he continues to stay on TV, I guess. So maybe the dude was right. Still, I would take my numbers from Spot Gamma before I would take them from Bloomberg. It doesn't hurt to put them on there, though, right? I've found that people can provide levels that I wasn't even looking at. And it doesn't matter if they've been trading for 2 weeks or, 20 years. If you give me a level and it turns out to be right, then you must have got it from somewhere that I wasn't looking. I love it. So why not, right? Mark it out. But 5,000 and 5,100 was already Spot Gamma's levels. So maybe the guy read Spot Gamma and then was sharing them on Bloomberg. Round numbers are something we should already be focused on anyways, simply because like 5150 yesterday or 5250, it's a round number, so it's an options level. Even though Spot Gamma doesn't necessarily have it listed as one, I believe what Tom Sosnoff says when it comes to options, that a lot of people don't understand options and a lot of people hate math. So they'll go for the round number and the simplest number to do the math on. Not because it's the better strike or anything like that, but just because, oh, it's the round number. They'll focus on that. It sounds crazy, but they do. And I've learned by now that just because someone's a fund manager, it doesn't mean that they're good at their job or that they're smart about the market. I've seen some complete idiots that are fund managers, and thank goodness they're not managing my money. They don't know squawk about trading and should just stay in their own lane or maybe go learn how to be a trader. So I don't give them any credence just because they have the tag of a fund manager behind them. Maybe they're good at managing people and they get a position as a fund manager. Who knows? Some good insight on that is Thinkorswim's platform. They made another one called Think Pipes. It's not accessible by retail traders, but yeah, it was like dummy proof when it came to options. It would have all these pop-ups explaining what a debit spread is and a credit spread is and how to calculate your risk, and completely like dummy proof. And it wasn't for retail that they were dummy proofing it for, right? Because we don't have access to that platform. Went on a tangent. Saw a squirrel. VIX is still bleeding off. A lot of different perspectives on why that pop happened, but the consensus seems to be the concentrated shorts that were in there got ran right the hell over, and their short covering added to the typical spike that you would already get, and that sent it into extremes with velocity. Seems to make sense. It was interesting. It was on Thinkorswim, an article that talked about how that trade, short VIX, was emptied because everybody got out, right? It ran to 65, and it's already getting reloaded. It was an interesting read, a little long, kind of nerdy, but I posted it in the chat if you guys want to scroll back and find it. Bitcoin is up 4.5, but on a 5-day move, they're still down 13%, which means they were down 18, 19%. This very likely is just a dead cat bounce. It's going to pop into resistance and then very likely roll over. That doesn't mean it's going to roll over and drop lower than the low that it's already set. Just that, this rally doesn't have legs yet at this point. It has a lot to unwind. Gold, same thing. It's up 1.5%, but it's still down, close to 7% over a 5-day period. China ADRs, the KWEB, China Internet ETF, still down 3.5% over 5 days. It's up 0.75% this morning. So what, Baba, Baidu, JD, PDD, that group might be getting a little bit of a pop. We could see emerging markets, China, the KWEB. So those imply that China's getting a little bit of a pop. Still not looking for that to follow through yet. I was looking at not emerging markets, world markets versus SPY yesterday. And that's basically US markets versus world markets. Generally, we lead that, right? So the ratio is usually pointed to the upside, but it's in a bull flag. And of course, that could just also be a topping pattern and we could roll over. So at this point, if we're not going to be leading into the last part of the year, where do we focus our attention? Right? India, back to China, since they're fixing their real estate issue, and where do we go? What's the wave going to take us to? It's a good question if we're going to top out and roll over. And that's all that's up. Like where's the big dogs? We don't want a market rally on pot stocks and Bitcoin, because that's not a sustainable market rally in S&P and the NASDAQ. We don't want to be led by those two. Pot stocks are up, but they're still inside day breakout. Be lucky to get a breakout on the week. We're underneath year-to-date VWAP too. Yeah, Bitcoin popped right into yesterday's Globex, so that's stuck. If we can break out of that, though, there is a gap close at 20 to focus on. Gold miners look good, but there's a half back there, right? We're very likely going to hit that half back. And even if we don't, say we just get rid of this one, the half back of yesterday is going to be an issue. And that was a really deep sell-off, so a little bit of a knee-jerk reaction the other way makes sense. So 35, call it 35.40. Yeah, that doesn't look good at all. So we don't have a market ready to run yet. We need more out of the market than this, and it needs to be better players. Keep my eye on finance, whether it's KRE or XLF. I like KRE, so really want to watch the banks. We need the banks, and we need consumer discretionary and technology, right? We need the Mag 7 to at least not fall, but preferably that they rally, right? So take a look at Microsoft. It's got the halfback. It's got to at least get through that as a starting point. And you can still use that big candle on Microsoft, just like we're doing on the ES. Sure, we're above the half, but we've got yesterday's halfback to get through. Call it 402. Same thing with Apple. Amazon, Google, kind of get the idea, right? And every one of them seem to have this too. All those sellers right there. Now, sure, we got the buyer on the other side, but we haven't tested those buyers since then. Are they still going to be down there willing to buy at that 155 range, for an example, on Google? So we need the Mag 7 to at least start to look a little perky. Get some financials. Otherwise, news dominates today. We already got our levels laid out. It's really clean to the downside. Break this low and it's game on. And we're in negative gamma, so they will sell into selling. Keep that in mind. We don't see solid B bottoms and rallies into the afternoon after a solid fall when we're in zero gamma as often as we would if we were in positive gamma. So it's not that it can't happen, just that it usually doesn't. If we break down lower, it's probably going to be really fast. If we break up through this high, it's very likely going to be grindy, choppy, maybe a bit like what Tuesday looked like. Tuesday wasn't bad, right? It was just lots of pullbacks and it was a grind, choppy. Watch the news, watch the clock, be careful, be safe. I'll see y'all tomorrow.